talk about any material changes to Vanguard's outlook since the beginning of this year?
One thing that's been evolving over time has been our views on Fed policy. Right? So heading into the fall last year, you saw a larger emphasis on international factors. The Fed started to include it in their language, in their communications, in their statements. So I think that's been a key to pushing out any further rate increases beyond what we had foreseen. We started out thinking that there could be 2, possibly 3 rate hikes over the course of 2016. In all likelihood, it's looking more and more like there may be 0. Right? There's a chance they may go in December, but based on international factors, you had concerns around China and oil price declines, warranted or not, maybe impacting Fed policy to some extent at the beginning of the year. That's since passed the baton to Brexit and concerns around Brexit, a very much unforeseen event.
I'll say, to give credit to Vanguard, and again, knowing that this is the future and we treat it in a distributional sense, which now we hear things such as super forecasting and things as distributions, to give credit where credit is due to Vanguard. We've had that approach well before these books. And with that appreciation of trends, and again, we update our forecasts as we go, and we'll never have a crystal ball. That said, to give credit to the team. Because generally the outlook for the economy over time is that the U.S. economy is going to remain resilient, not grow at 4% like the good old days, which was levered, but 2%. It's right on target. And that the U.S. economy would achieve full employment this year, or our best estimate of it, right on target. That emerging markets would not have a cyclical bounce this year, which many in the industry thought that they would, because there's a structural need for deleveraging in debt. Not that they were greater, emerging markets, but they would still struggle economically, right on target. That China would not have a hard landing despite significant fears in January, and yet there's a growing buildup of leverage in the Chinese economy, which policymakers need to address, which we won't see the story determine at the end of this year, right on target. Inflation, that there's still deflationary bias in the world. The drop in commodity prices and oil prices beginning of the year certainly surprised even us. But that said, as we would weather through that in a strong dollar, that core inflation in developed markets, although still low by historical standards, would not keep falling and falling, right on target. And finally, for the markets, twofold. One is that returns, we've had this guarded, not bearish, but guarded outlook, right? And as everyone knows watching this video, Vanguard does not offer, I think appropriately show, short-term point forecast what the Dow Jones Industrial Average will do, the S&P 500, or the global bond market. But that said, more likely than not, we will have lower than historic returns. But again, probability, we're certainly skewed well above 50% that the returns would be positive. Now, who knows it the rest of the year? But the stock market, despite the volatility, is setting new highs. Again, more to say, that's 6 months. That's not part of our forecast ethos, but doesn't surprise for us to see. And then finally, one of the few in the industry that, despite the low level of interest rates, we were underscoring very strongly that there's still the role of high-quality fixed income diversification. So yes, returns are low, expected going forward, but despite the low level of interest rates, the diversification value they've played for investors' portfolios, and to look through that low or even negative interest rate environment as a ballast for equities in times of stress. We saw it through Brexit, and we've seen it so forth. So I say that not as because credit where credit is due to Vanguard as a firm, because in part because we have the ability to take a long-term view, and we force that I think that's given us the benefit of trying to look through, when possible, through the noise that we will inevitably see. And we will, just like the past 6 months, we'll have to update our thinking. Things will catch us off guard. But I'd give high credit at the same time to our outlook, because it's been more of it's been on point than been off base the past 6 months. But not to be complacent. We'll have to continue to evaluate in this uncertain environment.